Hi, welcome to my Mortgage Advocate. Today we're going to talk discount points and lender credits. What are they and how are they related? But before I can explain what these are, we need to take a step back and talk briefly about something else. Yields. All right, so yield basically is the profit on a loan that the lender or investor expects to make on the mortgage. So once they've taken into account all of the origination activities and costs associated with those and all of the closing costs, it's how much they expect to make on the loan. So for example, let's say the prime rate, which is the rate that banks lend money to each other, is 2.5%. And the lender wants a yield of 1.5%. So you add them up and you get 4%, right? So 4% is the target interest rate. Okay, so now that's out of the way, let's talk about discount points. Discount points are a way for you as the borrower to lower your interest rate. All right, so while also allowing the lender to increase their yield to make their target profit on the mortgage. So the target is 4%, right? So let's say that this week the lender wants to advertise 3.75%. So how can they do that? Well, they do that with discount points. So one discount point increases the yield by approximately 1/8%. So it's not a one-for-one situation. It varies by lender, but the standard is usually that. So it takes approximately 8 discount points to equal a 1% reduction in your interest rate. Okay, so in our example, the difference between the advertised rate and the target rate is 0.25%, or 1/4%. All right, so to make up the difference, they offer you 2 discount points. So now you're probably asking yourself, how does this affect me? Or how much does this cost, right? So one discount point is equal to 1% of the original loan amount. All right, so if you have a $200,000 loan amount and they offer you 2 discount points, that's 2% of the loan, $200,000 or $4,000, right? So discount points don't have to be whole numbers either. They can be fractions, they can be portions. So you may see 0.75 discount points or 1.5 discount points. This is an additional fee that is added to your closing costs, so keep that in mind. And this fee is all a prepaid interest. All right, so a discount point is something that lowers your interest rate but has an upfront cost. Stick a pin in that, we'll come back to it. All right, so now let's talk about lender credits. Lender credits are the same thing except in reverse. The lender advertises an interest rate of 4.25%. All right, so their target is 4%, so they're in the positive for 0.25%. Which roughly comes out to about 2 points. All right, so for the 2 points, they are calculated the same way as the discount points. So 2% of the $200,000 loan would be $4,000. All right, so the lender may offer you a lender credit of $4,000. All right, so now how can you use this information? All right, so now that you know what discount points and lender credits are, how can you use this to your advantage? All right, here's a chart that I've put together to help determine which is best for your situation. All right, so let's use the same examples that we discussed earlier. So we have a loan amount here of $200,000. The first row contains the rate for each of the situations, and then the next row contains the points. All right, so the scenario for the first column, let's say you can afford to pay points at closing, right, to buy down your interest rate, and you're planning to stay in the home for a while. Or maybe it's your forever home, right? So you pay up front, right? But you may end up saving over the life of the loan. So now the second column, let's say that you're satisfied with the market rate and don't want points in either direction. Okay, this is important. You can use this as a baseline for loan shopping and comparing rates with other lenders. So if one lender offers you 4% with no points, and another lender offers you 4% with 0.25 discount points, then the second lender has a higher base rate. All right, so then the third column, let's say you're buying your first home and don't want to have to pay a lot of cash up front, either because the home is going to need some work or you don't have a lot of money for closing costs. Or better yet, you know you're going to be moving in the next few years. It's another scenario. So this may be the better option for you. You'll end up with a higher payment, but will receive lender credits toward your closing costs. So if I'm shopping around, here's what I would do. Right, whenever I receive the loan estimate, and every lender is supposed to give you one, I'm looking for any discount points or lender credits. If I see any, I want to know what the rate would be without either of those. Ask your loan officer to see what the rate would be without points. Now you have a true baseline for comparison between lenders rate-wise. So once you've selected a lender, then discuss how many points or lender credits you would like, if any. Okay. So to summarize, discount points are a way for you to lower your interest rate with an upfront cost, and lender credits are a way to get credits towards closing with an increase in your interest rate. A discount point is equal to 1% of the original loan amount, but the amount being discounted can vary from lender to lender. When shopping around, look at the loan estimate to see if there are any discount points or lender credits, and get the loan officer to get you to the rate without points to get a baseline for comparing interest rates with other lenders. Also remember that the interest rate is only one element of getting a good deal with the particular lender. So you need to look at your closing costs as well. I plan on doing a video pretty soon on the other things to look for in your closing costs and also in your loan estimate. All right, if you find this information informative and of real value, please consider liking and subscribing. Let's help that YouTube algorithm get this out to more home buyers and others interested in obtaining new mortgages. Thank you for watching, and happy mortgage hunting.